Hey everybody, Julian Marchese here. Today is July 9th, 2013, and in this video I'm going to give you guys a market update, my current positions, and what I think about the market going forward. So first of all, I want to uh, do an announcement here. I recently launched my Marchese Financial letter. If you go to my website here, marchesifinancial.com, and click on MF letter in the top in the tabs, you can see basically what I'm offering now with my Marchese Financial Letter. 50% of all the profits, subscription profits, are going to Sick Kids Charity, which is a charity up here in Canada that I've been connected with for quite some time now. It's really inexpensive, under $1 a day, so it's $20 US dollars per month. And I'm going to bring up an example of what you get with the Marchese Financial Letter. Basically, it's a 3-page report, and on the home page, obviously, you got the date. Most of the writing here is just basically my recap. You get to see all the positions that I'm running, what I'm talking about, what I'm looking for, what I'm looking to enter, basically, you get to see my account recap. Obviously, you get a little quote board there. You get to peek into some of the indicators that I watch for the stock market breadth. And then also on the second page, you get to see basically a couple of my trading strategies that I'm just going to release with this Marchese Financial Letter, which is my BTFD trading strategy, which has fantastic performance, and also the extended run trading strategy, both long and short models. And then you also get to peek inside of what I use to trade the S&P on a very short term trading horizon, which is my model. Basically, whenever it's below that blue line, it's bearish; above, it's bullish. The higher or lower you go, the more extreme the reading is. So, uh, you know, this is also what comes with the letter. And then on the third final page, I bring up a daily statistical study that I utilize in my trading, which is incorporated into my models. And obviously, this can give us a slight edge up or down in the markets over the next few trading days. And then obviously, we have a disclaimer below that. So that's everything you get with the Marchese Financial Letter. It's packed full of stuff. Um, if you want to look at the strategy performance of the two strategies included here that I will update with buy and sell signals, both in the S&P 500 and Russell 2000, that's been the equity curve since July 1st, 2003. So very consistent performance. Um, this is two systems I've been using for the past 7 months, and they've been performing extremely well. So that's what you get with the Marchese Financial Letter. Check it out. Just go to my website, marchesifinancial.com, click on MF Letter, and then you can check it out, see if you'd like to make it a subscription. So back to the market. So what are we looking at here? We've seen a lot of volatility in the equity markets over the last month and a half, ever since this whole Fed talk, Fed tapering has come into play. We've seen a lot of equity volatility, but all this volatility has really come from the bond market. And with this taper talk, obviously, bond funds and the market's obviously aggressively and biased to the upside. This is all liquidating, and all this volatility is starting to get basically worse and worse, and it's been spilling over into a lot of different markets, like gold, that has experienced a large move. And we'll talk about that a bit later, and especially in the dollar as well. You could see the dollar is just ramping up to new highs above that $85 level on the index. So this is 3-year highs here. I personally think that this is a breakout and this is going to hold. QE, quantitative easing, has been going on now since 2009, ever since the end of the recession. And with how the Fed, Bernanke's exiting this year, potentially this year as well. I think there's a lot of events, and the amount of time that's passed, at least to see some volatility or fear that QE will actually um, start to be run down. Do I think it's going to be for the long term? I highly doubt it. I believe that once we turn off the printing press, some economic problems are going to persist, or at least come to light. Some sort of correction will probably happen, and then the Fed will probably just reinstate it again. But for now, I think in the cycle of QE, I think we're nearing the end of one, and we're going to experience some equity volatility. Now, equity volatility typically means to the downside, but I do not think we're going to see any major correction. However, I am positioned short and long volatility. It's a position that I've initiated really yesterday. However, I have held a small short. I made some good profits off of the bounce into here. I thought the 1610 level was going to hold and we were going to return lower, but that deemed to not be the case. So now we're looking at the 1650 level. If we break above that, I doubt we see much activity up there. I think it could be a false breakout. But in general, we've rallied 100 points over the last 2 weeks. Um, I think that we've got Fed minutes tomorrow. That's a huge deal. Everyone's watching it. The market has been powering up into it with good unemployment reports. I do not see any reason why the Fed would basically take away their newly found hawkish stance. So I think maybe, I don't know, the market might have priced it in. It looks like it could have, but I think still that the tail risk is to the downside. And I highly doubt that we see some sort of QE style grind up like we've had since November, with the newfound fear of tapering, because it's in the back of everyone's mind right now. So I think the higher reward to risk trade at this point right here is short. However, I'd be monitoring that closely. I'm also short China. That's a position I entered yesterday. Got in a pretty good price. I entered near the high of the day. So we're basically at break even there. But, there's a lot of things. Number one, we've got a major trend to the downside in China. I don't think that's just going to stop with easy money kind of coming to an end, or at least the fear of it. I think that's going to continue to weigh on China. Copper continues to break down. Today, it's really the only commodity down. So that's showing a little bit of weakness. I don't think the inflation numbers that came out yesterday are going to make a huge difference. We were 0.2 above expectations, so that's really not a huge deal. And inflation, I don't, it's really doesn't do much for the Chinese economy. It just makes it harder to achieve real growth. So I don't think these inflation figures really mean much, except we wait. The recent liquidity crunch that we saw in June or late June, uh, we believe that that was the central bank of China, People's Bank of China, to try and halt, the shadow banking lending and try and halt, credit expansion. However, that appeared to not actually be the case. Credit expansion actually continued, even with those massively high interest rates, and they were much riskier, of course, loans with those higher interest rates. So I think that just kind of provided more fuel to the fire. And at this moment, especially where we are in the cycle, to me, it really depends on the cycle. For example, S&P is near all-time highs again. The Russell's already at all-time highs. But look where China is. Look where emerging markets are. And even on this recent rally, they can't get a bounce. So what does that mean to me? That means we're going to fall hard once we reverse in U.S. equity. Once there's a downturn in other markets that have been outperforming, these underperforming markets are going to continue to underperform and potentially, much worse. So if we look at China on a longer time frame, we're at a very, very important level. Either we're going to bounce here and I quickly take out my shorts for a loss, or we're collapsing through, and the collapse through could be quite detrimental to the global economy, and that could reinstate QE again. But until then, I see no reason to hold long positions under the same thesis as QE as we did prior. I think now that I would just expect equity volatility. We may see new all-time highs in the coming weeks in which I'll lose a bit on my short positions. I'll have to manage that tightly. However, I think once again, it's more likely we see chop and volatility in equities than anything else at this point. Now, my other positions, I am running a very small, very, very small long bond position, which I got in on the puke on Friday. I played the long bonds here to there, and I got out before the unemployment report, so I'm doing that again from the Fed minutes tomorrow. probably going to take out my long bond position tomorrow. However, I might just hold it on as a hedge in front of the Fed minutes, as I am short equity. And all these markets are going to move together as the dollar either collapses or rallies hard. I'm also short the yen. This is a very popular macro trade right now. I don't see any reason of this turning as of yet. Small position, managing it technically at this point. A rally in this pair could possibly, sorry, a rally in the yen could possibly because of just a fall from the dollar if we have if expectations of tapering do not come to fruition tomorrow. So, we could see some volatility there. And I am also short the Australian dollar. That was the pound. Same type of story, Australia is especially their central bank is very adamant about cutting rates at this point. They need to with the China story. Their economy has been getting hit hard. I don't see any change in that story once again, so this is kind of a China position. Then you also have the other side of it. US dollar continues to rally as, tapering. So these are two different themes, completely opposite directions in both currencies, the Aussie and the US dollar. So I like that trade. Why not continue to go on that ride? I'm managing it very, very tight as well. My risk is really up to that 92 level. I don't want to see it above there. It's a very short-term trade. It's once again, it's a Fed trade for tomorrow. If we continue to see the same type of activity, the US dollar is going to rally hard through those highs, and these currency pairs are going to fall. I was interested in getting into the pound yesterday. I missed the move, unfortunately. However, I will look to reinstate for a larger trade if we see a bounce there. Gold, same thing as bonds right now. I'm playing it as a technical bounce. I am long and as a hedge to my equity shorts. And I'm also short Europe for very similar reasons. Just the global economy right now with easy money potentially reversing that whole thesis, potentially reversing over the next couple of weeks to months. I like these trades as shorts, and I think we're at very precarious levels, and the technical damage that we saw on the Fed last meeting is enough to continue a long-term downtrend. I think we're in a really distribution top in Europe, and obviously we're in a sustained downtrend in China. So that's my thoughts on the market right now. So basically, follow the trend at this point. I'm fighting the trend a little bit in U.S. equities, however, keeping it very tight. I don't see any reason for the Fed to change its speech right now, so I'm going to continue to follow that trend. I'm not holding any major positions into the Fed minutes tomorrow. Beforehand, I'm most likely going to try and go delta neutral on my equity positions. So that's about it. If we see a surprise, the Fed turns back to dovish and we just blow through equity highs and all these markets rally, just got to cut your risk immediately and wait for the bounce again. Wait for new all-time highs and the next Fed meeting, see if there's a reverse back as these markets cycle higher. Then that could be a very interesting short opportunity. But at this point in time, I do not see any. Once again, I think the risk is to the downside, and I don't want to be exposed to that risk by being long equities at this point in time, unless my technical models are telling me to do so, which I have in a separate part of my portfolio. All right, so everyone, check the market's financial errors, see if you like it. It's very cheap, $20 a month, 50% going to charity. Thanks for watching this video, guys. Hope you have a great trading day.